The results are in. Inflation is on the rise, and this sent markets into a tailspin as yields soared on the back of rate cuts getting pushed out beyond May. So will this derail what has been a stellar year so far? Let's talk about it. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell. Let's get into it. Today was one of those really rough days for the market. It was like you went out for the night, got really drunk, you wake up with a terrible hangover and remember all the shitty things you did. That is what today felt like. Look at this. Semiconductors technology, terrible day, absolutely terrible day. Except for Nvidia, this magical asset continues to outperform on the upside and the downside. What we did see was healthcare. They performed the best performing sector. And that's because these big names, AbbVie, Eli Lilly, United Health, were really bid up. And I think we actually did see a little bit of a defensive rotation, flight to safety, I guess you could call it, into these bigger healthcare names. And we really have to see if this continues over the next couple of days. That could be a bit of a risk off signal. That being said, the winners today, apart from Visa and MasterCard, were just the stocks that performed really well on earnings. We're looking at waste management, we're looking at ELC, these type of names, as well as the healthcare names. But all in all, very rough day for the market, including the Russell 2000, down 4%, S&P 500, Nasdaq, RSP, all down more than 1.5, 1.3% respectively. We did, however, at 3 p.m. see sort of like this late day boost. Ton of zero DTE buyers, probably people finding value in this area. And I mean, this was actually quite substantial. Look, the RSP nearly down 2.5%. Dip buyers did come in very strong at the end of the day, and we'll see if we get follow through tomorrow or further sell side. Either way, strong buy side support at the end of the day, but overall still a very rough day. Now, looking at overall trade for the S&P 500, this is the daily chart. Let's actually just zoom in to today's trade, and we could see that we had a massive gap down from yesterday. We formed this doji, gap down, sellers sold us all the way down to the 49.20 area. Then buyers actually found value at this area, started buying, especially late in the day. And buyers found value at the same place they found value last week. This was last week's Monday's candle. This was last week Tuesday's candle. And we saw a huge amount of dip buyers come in right here, dip buyers come in right here, and pushed us further up into the week. And we're seeing the same type of buy side support in today's trade. So for the bulls, 49.20 is an absolute key zone that they absolutely must hold. If we do go below the 49.20, that's going to be really rough. Now, one thing I do want to note is that the 49.20 area is actually the gamma flip zone. So if we actually went below here, we were in a negative gamma environment. So it's an absolute key level for bulls to hold tomorrow and for the rest of the week. That being said, as long as we are above this area right here, 49.20, dips are to be bought because we are still in positive gamma, looking at 520, 540, 560. However, if we do get below this line, we are going to get into negative gamma and do expect a lot of volatility. And if we do break below the 49.20, let's say we go up, retest, I do expect us to go and test this level right here and test this level right here. And again, we know that these are significant levels because it's the lows from 2 weeks ago and this poor structure sits right here. So if we do break below this level, expect us to go to the 48.59 level very quickly. However, we did see a lot of dip buyers come in at these levels right here, push us up to the upper third of the candle. Bears still won, however. You would say that the bull support is quite strong, at least intraday. And we do want to see a push above the high of the day's trade. But a close tomorrow above this high would be probably the best, and into the 5,000 level would be even better. That being said, if we actually have a look at what yields are doing right now, you can see that they're up in after hours, but they were actually up even more during normal trading hours. Everything across the board, RSP was down for the day, mid caps, small caps, the Nasdaq 100. You can see the bonds were down significantly on the day, and pretty much every sector was in the green, including growth, value, even some of these obscure ones like China. Every single sector was red for the day, a pretty red day across the board. Now, and all of this was dependent on CPI. CPI inflation declined to 3.1%, but we were expecting 2.9%. On a monthly basis, CPI and core CPI rose 0.3%, 0.4% respectively. The index for shelter continued to rise in January, increasing 0.6% and contributing over 2/3 to the CPI print. The food index increased 0.4%. The food away from home index increased 0.5%, and energy fell 0.9% respectively. And look at what this did for yields. We literally we're expecting a rate cut in May, no more. It's now moved to June, 50% chance of a rate cut in June, 32.9% of a rate cut in May. So still big odds of maybe a rate cut in May, but it's very, very likely that we get one in June. And this is what the market didn't like. These rate cuts are being pushed further and further out. We were looking at March, we were looking at May, now we're looking at June. What's next? July? I think what we have to do is let the market stabilize, see what happens, because we did see quite a bit of dip buying at the end of the day, and we'll need to see what happens with the Fed fund rate futures. And we do get PPI at the end of the week, and there's quite a lot of big data points still left in this week, like retail sales, etc. So let's have this week play out before we make any rash decisions. That being said, having slow rate cuts is not a bad thing. You can actually see here that when the Fed is slow to cut rates, the markets actually go on these long, enormous rallies. Whereas when the Fed is fast to cut rates, it's normally very choppy action leading to drawdown, simply because when the Fed needs to cut rates fast, there's underlying weakness in the economy, aka recession. And this drawdown is actually well within seasonality of a fourth-year presidential cycle. This is the Carson composite cycle. And you can see here that from about middle of February all the way to potentially the start of April, end of March, maybe a 6 to 7 week period, we can actually see drawdowns in the market that actually go negative into the year as far as 1%. But we should actually use any sell-off, any drawdown we see right now as a dip buying opportunity for the rest of the year, especially because we do know that the economy is strong. And part of the reason why we're probably getting high inflation is because of the economy. And part of the reason why we did see an increase in inflation this past month is because the economy is strong, GDP is really high, and earnings are growing. These are the facts of the situation. And at the end of the day, we do want to use any drawdowns that we do get in the market as just dip buying opportunities for the long run, because this is going to significantly increase our 1 year, 3 year, and 5 year annualized returns. Now, looking at sectors, we could see here that healthcare was the best performing sector on the day. Like I said at the start of the video, possibly a defensive rotation. One thing to note is that energy was down 0.94%. In the face of all of this, oil was up because oil is an inflation hedge. But the fact that energy stocks were down tells us that everything we saw today was actually more of a liquidation, literally people pulling money out of the market, putting it in treasuries, putting it in their bank accounts, because that's where they can get some proper yields now. The 10-year is trading at 4.3%. Crazy when you think about that. So yeah, what we really saw today was just a liquidation, people pulling money out of the market, especially in these extremely rate sensitive and inflation sensitive stocks like regional banks, metals and minings, GDX. They were the worst performing sectors. And this is why the Russell was down nearly 4% on the day, because these sectors are heavily weighted in the Russell. Our best performing sectors for the year: semis, tech, software, down, all more than 1.5, 1.6% for the day. And really the real winners were like these defensive stocks that PS Staples, healthcare on the day. And yeah, just a complete liquidation. Now I have a great play that's looking like it's going to trigger at the end of February. It hasn't triggered yet, but I will let you know. And pretty much it's the S&P 500 when December to February is up 2.5% or more, and is accompanied by an all-time high in February. When we get that, these are the returns we can expect 12 months later. Now it's absolutely incredible, because normally that first quarter, so it'll be March, April, May, right, is very, very positive. We normally see the quarter return on average 5.09%, 17 wins, 0 losses. So this trade has actually never lost one quarter later. Likewise, the full year, so 12 months later, pretty much from March all the way to the next February the next year, average return 15.7%, 12 months later, 16 wins, 1 loss. The only year that was a loss, 1987, where the quarter was actually positive in that year, but October, Black Monday crash in 1987, and then the November is what made the full year negative, only negative 5.8%. To add, the max drawdown in every single year except 1987 was less than 10%. 21.2% in that year was the max drawdown. Other than that, remove these 2 months, pretty positive year nonetheless. Very, very positive stats if we do close February up 2.5%, and we have already made the all-time high in February. Now currently we are trading at 10% so far, probably a little bit more in 2024 for the quarter, but when this plays, this does set up some bullish price action for the rest of the year. Now looking at sentiment, the fear and greed index is in extreme greed at the current moment, and the BOFA bull bear indicator is at 6.8%. So we are getting to like these frothy market conditions where it is looking like maybe we should start thinking about taking profits and not really adding to any more positions, at least according to these indicators. Personally, I invest every single week, regardless of what market conditions or the macro are. But just saying, like, according to these sentiment indicators, which are actually quite reliable, especially if you look at the longer term, we are getting to these frothy levels. That being said, are things getting too frothy? Well, according to this chart right here, not yet. But Nvidia is tracking very similar to what Cisco did during the dot-com era. Now, essentially what Nvidia has to do is 3x in the next 433 days to be at dot-com bubble levels. And also you have to understand that the valuation here was a lot different. Cisco was barely making money. Nvidia is growing earnings significantly. So are we at dot-com bubble levels? No. Do I think we're going to get there? I don't think so. I think big tech makes a lot of money. Can we get there? 100% yes, we can. You'll be astounded at what can happen when the market starts to squeeze. Today, we're actually going to look at the consumer sentiment because we got inflation numbers. Now, this is very interesting. I saw this floating around Twitter, and this is credit card debt and US total net worth. Now, we can see here that credit card debt has actually gone up quite significantly. A lot of people were quoting the stat. What they don't know is that net worth has increased 251% since the year 2000, and it's actually increased significantly more than credit card debt as a whole. So this number would be shocking if it was like if these two were diverging. But as it is right now, I think that's actually quite sustainable. And we are seeing an acceleration in net worth versus credit card debt. Now, looking at consumer finances, so the household debt to service ratio is currently sitting at 9.9%. So it's actually at historical low figures, at least in comparison to, right before the GFC, right before the 1980s crash. Look at the 2000s. So we are at historically low levels. The lowest we actually got was here during COVID. So people have taken up a bit more credit. But if we actually look at to flows into early delinquencies, it is a bit worrying that autos and credit have been ticking up, especially since about 2022 into 2023. And at the same time, student loan debt, which resumed last October, I believe, is still pretty much flat. So a couple of things. Either people are not paying their student loan debt, or this is set to rise as well. At the current moment, it doesn't look like an issue, but we'll see what happens here. But for the most part, when we do look at this data objectively, we can say that household debt service is very manageable, and for early flows into delinquencies, student loans are at historical lows, whereas auto and credit card is trending at about the average, maybe slightly above the average. That being said, looking at consumer balance sheet, very, very strong. We have $171 trillion in total assets against $20 trillion in liabilities, and most of these liabilities coming in the form of mortgages, and those mortgages making up total assets in the home section of total assets. Now, this is really great because 8% of total assets are actually deposits, and then other financial assets is 41%. So you're looking at 49% of assets in American households is actually like probably liquid within 1 to 2 days. I mean, like pension funds, other tangibles and homes, those are not really liquid assets, but the fact that 49% of assets are available within 1 to 2 days or 1 to 3 days, I mean, I can sell my stock and have the cash ready in 3 days is really, really good. And it really does bode well for the consumer that if they do need money, they can draw on these, as well as drawing onto other forms of equity if they really do need it in the long run. But that being said, the consumer, this looks very, very healthy. I mean, if you look at a company's balance sheet, right, and you saw 171 billion in assets, 20 billion in total liabilities, that's a very healthy balance sheet, especially when they have 49% of it in cash and cash equivalents. That's a balance sheet you buy all day, every day. Now, looking at consumer saving and borrowing, now the average personal saving rate is 8.6%. So we are sitting well below the average saving rate. And that's because households have favored excess savings over personal savings, as you can clearly see in this diagram. However, this can be a concerning sign, especially as we do deplete into household excess savings. So it's definitely something to watch. That being said, revolving consumer credit outstanding is actually at historic lows. I mean, not compared to what we saw in COVID, but in comparison to history, consumer revolving credit is actually very, very low. And this is a very healthy consumer. They got a lot of excess savings. They are actually still saving, and revolving outstanding credit is not that high. This is exactly what you want to see in a healthy consumer. At the same time, employment and wages are at historic levels. Look at the unemployment rate. The 50-year average is at 6.2%, and the 50-year average in wage growth is 3.9%. Currently, wage growth is sitting at 4.3%, above the average, and the unemployment rate is sitting at 3.7%. That's below the average. This is exactly what you want to see. So consumers have jobs, they're holding on to jobs, they're gaining wages, they have limited debt, their balance sheets is great, and they're still saving, and they have a lot of excess savings. This is signs of a very strong consumer. At the same same time, we're looking at job openings, jobs quits, and jobs layoffs still beating the historical average. I mean, jobs openings are, although coming down from their peak, still well above the historical average. All in all, the consumer is strong and there's jobs for the consumer. And we do know that if the consumer is strong, the American economy is strong. Because yesterday I showed you this chart. What's the composition of GDP? 67.7% of it is consumption. And if the consumer is strong, this is really going to be a tailwind for stocks in the future, especially as the government continues to spend in an election year. Something I also want to add. Now, this is the NBER in making a recession determination. And pretty much it looks at these 6 variables right here. And if they're in the negative, the economy is in a recession. If the majority of them are in the negative, the economy is in a recession. The only one that's in a recession right now is industrial production, barely at negative 0.3%. And we do know that manufacturing is coming out of a recession. So the consumer looks strong, the economy looks strong, the labor market looks strong. All in all, this looks like a very, very strong economy. Now let's talk earnings. So we got quite a number of earnings today. It's actually a pretty big day. Now, keeping up with the theme of the consumer, we're actually going to have a look at stocks that are proxies of the consumer. We're going to look at Coca-Cola, Marriott International, and Shopify. Now, before we actually go into that, let's actually have a look at the earnings scorecard. Now, according to BofA, 334 companies have reported out of 500. 72 beat EPS, 63 beat sales, and 50% are beating both. That's really, really good, actually. And have a look at technology. 80% beating EPS. Com services, 63% beating EPS. So not quite as good as technology. But have a look at healthcare and financials right here, guys. That's actually kind of crazy when you think about it. Look at consumer discretionary. Look at consumer staples. So this has been a very, very good earnings scorecard for the most part. And a lot of it coming from EPS beats as well as moderately from sales beats. But that being said, very good earnings as a whole. Now let's actually talk about Shopify, Coca-Cola, and Marriott. Now there's been some major changes in the tape for gamma. We can see 5100 is now the call gamma resistance. Kind of crazy when you think about it. We were at 5000 just yesterday. And this reinforces the fact that positive gamma is actually rolling up the tape, especially to the 5100, 5200 area. But something to note as well, the reason why the gamma flip zone has actually moved up the tape is simply because this right here, a ton of put gamma, a ton of negative gamma has moved up the tape as well. A ton of negative gamma has come into the tape, and this is why we're seeing the 49.20 level as the gamma flip. Now, until this level is broken convincingly and we have a daily close, maybe even a weekly close below the 49.20 level, all dips are to be bought looking at the 5100 level. That being said, we are seeing bear positioning moving into the tape. We do have to play the probabilities, and probabilities right now are likely that all dips are to be bought because we are still in positive gamma and dealers sell dips by rips, and that's the most effective trade to make right now. That all changes below the 49.20 level. Now, something really, really interesting. I talk about gamma exposure a lot. Something I rarely talk about is Vanna exposure. And this is a post by Squeeze Metrics that I think we should look at because it's absolutely fantastic. And it just goes into some unique positioning in the S&P 500 options market right now. Dealer SPX Vanna exposure is at all-time highs. Specifically, VEX is sitting around $500 million. Now, that means when the VIX rises, there's an unusually high mechanical bid for S&P 500, which reinforces this auto dip buying mechanism. It's very supportive. Another way to understand this is that dealers are long skew. That's because customers have sold a lot of low delta out the money puts. So customers are short puts. Of course, this is just a bullish thing. It indicates that customers are positioned in such a way that they would be hurt pretty bad if stocks were to fall fast because they short the puts. Extremes give way to extremes. We are actually a long way from that possibility right now, but things, as you know, can happen quickly. As far as hypotheticals go, this one is worth paying attention to. So customers are leveraged to their eyebrows. They've sold a ton of puts, and if things are to move downward very, very quickly, and I'm not sure what that looks like, maybe 5, maybe 10%, a lot of people in the market are going to be in a lot of pain because of the amount of leverage they have. And this is why I almost never preach to use leverage. I haven't given you guys a single option trade ever, and there's a reason for that. That being said, dips are a part of the market, and it's best to take advantage of them. We can see here, this is S&P 500 monthly seasonality back to 1928 from BofA Research right here. And they suggest that normally in February, we actually do get a dip or a pause. It actually has a slightly negative return. I'd call it flat. So if we actually are to par all of the gains that we've made in February, it would actually be completely normal within seasonality. And then we would normally see a pretty positive March, positive April. So that is not completely out of the books. That being said, all of these dips you see right here should theoretically be used as dip buying opportunities. And I do think that February is also negative in a presidential year. Okay guys, so I got some really interesting charts from BOFA. These were charts on the weekend. I only have them now. And the reason why it's good to look at these charts is because 78% of asset managers, family offices, just people managing money look at BOFA research. They look at the exact charts we're looking at right now. And it's really good to see what they have a look at. And this is the technical analysis that they use. Now, this is the S&P 500 monthly candle chart with round figures. Essentially what happens when we got to these big figures of 1,000, 2,000, 3,000, 4,000, 5,000. This is a monthly chart. And we could see that when the SPX across these big round figures, the SPX should spend some time above and below the 5,000 prior to continuing its mid-cycle trend. So let's take 2,000 for example. You could see it broke it right here, spent some time above, spent some time below, and then continued the trend. The same is true for 3,000, 4,000, and now 5,000. Now looking at the S&P 500 weekly chart with moving averages, this is a big cup and handle that almost everyone is looking at. Here's the cup, here's the handle, and you could see a measured move to the upside of this breakout, which is currently happening at between 5,200 and 5,600 on the upper end. Now this is a really interesting chart. This is Dow theory, so the Dow Jones Industrial Average right here and the Dow Jones Transportation Average, and pretty much the Dow Jones Industrial Average has hit new recovery and all-time highs in 2024, but the Dow Jones Transportation Average has not yet confirmed these highs. The Dow theory remains on its bullish signal from mid-July, but this bearish divergence sets up a non-confirmation, which is a tactical risk for equities. So industrials moving higher, transports not moving higher, and this is a bearish divergence and a non-confirmation of the rally above. Continuing with Dow theory, we look at the New York Stock Exchange, which is this top one right here, and then we look at the Nasdaq Composite, the bottom one. Now the Dow Jones Industrial Average and the Transportation Averages are price-weighted indices of 30 and 20 stocks, respectively. The New York Stock Exchange has 1,900 stocks. The Nasdaq Composite has 3,400 stocks. Using these two broad-based indices for Dow theory shows a confirmation primary uptrend, aka bull market, with new recovery highs for both indices in early 2024. You can see that on both indices, there's bullish confirmation of the uptrend in both instances. Very, very healthy. Now looking at the New York Composite right here, and then the New York Stock Exchange advanced decline line. The New York Stock Exchange Composite is actually going ahead, nearing or making new highs. The New York Stock Exchange hit new highs, but the advancing and declining issues in the New York Stock Exchange is actually trending downward, and this is a non-confirmation. However, do take this with a grain of salt, because the S&P 500 right here actually did the same thing. It made new all-time highs. However, the advanced decline line confirms the rally, and I think you should take this with more weight than the New York Stock Exchange, simply because managers are holding the S&P 500 above everything in their books, and their portfolios probably look more like the S&P 500 than the New York Stock Exchange, in my honest opinion. I mean, in the New York Stock Exchange Composite, the Mag 7 is simply not there, and that's really what you want to see, especially with these advanced decline line. It's equal weighted, it's not price weighted or market cap weighted, whereas this is. So to see this and this is a very healthy sign of the market, especially in the S&P 500. Now looking at the healthcare sector, this is the weekly chart with moving averages. You can see that this is a huge multi-year base. We're breaking out from it right there. Upside targets take us to 150 on the low end, 164 on the upper end. And with healthcare expected to report earnings over the next 2 years of 12% and I think 17% and 12% respectively, we can see why these targets could definitely be achieved and why this is looking very, very bullish. Now looking at biotech, we're forming a double bottom, and the very similar thing happened right here. We're forming this double bottom. Now if we do go ahead and break out of this range, upside targets see us at 127, and do expect the Russell 2000 to rally if this happens, simply because a huge amount of biotechs sit in the Russell 2000, and this is going to be a tailwind for small caps as a whole if biotech does get its breakout. Looking at the US Transportation ETF weekly chart with moving averages, the IYT has broken out from its early 21-24 big triangle base. Here's the base. It's starting to break out, as you can see right there. Upside targets take us to 320, 340. That's actually quite a move when you think about it, and that could be anywhere from 12 to 24 months later. There's no real time on this. Now looking at the RSP weekly chart with moving averages, we can see here that the RSP is attempting to break out from the 155 to 153 level. We already know that based on this past week's trade, we are actually breaking out in the RSP. Upside targets do take us above all new all-time highs at 164 in the equal weight to 177 and 185 upside targets. So very, very bullish. And again, no time on these, but I think in the next 12 to 24 months is very, very reasonable. Now looking at the IWM, we're sort of at this base right here, looking to break out. If we do break out, we're looking at upside targets at 234, not even all-time highs at 242 right here in the Russell 2000. That being said, if we do break out above this multi-year consolidation, yeah, upside targets, we do go high, and we could see there was multiple opportunities to buy the Russell 2000 at these, well, some might say generational lows, but very, very good opportunity to buy, especially here in October most recently, and you're up like 30% already, and it looks like you're going to get another 30% to the 234 level if this breakout does continue. Now, data in the week ahead, guys. So we got CPI today, and then we have retail sales later this week, as well as PPI. Those are the big ones, as well as a bunch of other data. But a very heavy data and earnings stacked week this week, guys. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment. Cheers.